5 key reasons your Australian superannuation fund is a legal tax haven. Hi there, I'm Jared Brown, Australian expat financial planner based here in Singapore, and in this video I want to share with you some simple reasons why you should be paying attention to your Australian superannuation fund. That is our pension fund, our retirement savings vehicle. That is one of the most tax efficient ways we have to save for our retirement, particularly if we plan to work and or retire back in Australia again. Number one, when we reach age 60, and reach a condition of release such as retiring or ceasing an employment arrangement, leaving a job, or 65 and we could be still working, you can transfer up to $1.9 million, that's Australian dollars, each into an account-based pension. Now that pension brings us to reason number 2, grows tax-free. No more tax on dividends and no more tax on capital gains. The tax rate is 0. That is on both dividends and on capital gains. The income that you draw down from this account-based pension each year is also tax-free in Australia. The next reason is you can make tax-deductible contributions to your superannuation fund. Now for us as Australian expats, what taxable income we have in Australia is the question we need to ask to determine should we be making contributions to our super fund. If, for example, we have a positively geared property and that property is rented out, it's generating rental income, we therefore have taxable income, we could make a super contribution to offset the tax on that rental income. Of course, seek tax advice, work out what's right for you. You might also sell a property in Australia, realise a capital gain, and use the carry forward or catch up concessional contributions to pump a larger amount into your super fund and claim the tax deduction that way. The final reason, which is one of the most attractive parts of retirement in Australia with superannuation, is the refund of excess franking credits. Now, the franking credit or dividend imputation system in Australia is effectively just levelling the playing field when it comes to the treatment of income tax on dividends. So if, for example, in very simple terms, you have a portfolio of bank shares or fully franked dividend-paying shares in Australia, that company has already paid 30% corporate tax before they pay your dividend. So they receive their income, they pay their corporate tax, and then they pay that dividend out to you as the shareholder. Now, because the tax rate on dividends inside your super fund when you retired is 0%, we actually want that 30% tax already paid back as a credit. And that is how the system currently works, as a cash refund on top of that dividend, obviously providing a nice healthy boost to your retirement income. So as an expat, it's not to say superannuation is the one and all we should be contributing everything into, but it is to say don't ignore it just because you're living offshore. You may find it is an incredibly powerful little tool to deliver a tax-free retirement income in your later years.